Hi all. So on the eve of the shutdown in South Africa, I thought I'd share some of my thoughts and provide some context as to what is currently unfolding in markets. Now with the globe in turmoil due to COVID-19 pandemic, investors are really witnessing unprecedented moves in financial markets. An indication of just how dramatic these moves have been, there's been a 30% crash in US markets in the last couple of weeks, and this was the fastest recorded in history. It took only 22 days to fall almost a third in value from peak to trough. Now, as this has been an event-driven crisis, coupled with high-frequency trading and index investing, the ensuing volatility has been spectacular in both directions. An example of this, last week, the 16th of March, US markets had their biggest daily decline since the 1987's Black Monday. And then this week, markets surged 15% over 2 days, including the single biggest daily rally on the Dow Jones Industrial Average since 1933. So the burning question as an investor is what to do in a market crash. Well, what is clear if we look at history is that the biggest risk to investors during these market conditions is the investor themselves. Our emotions, which are very real, push us to take actions that can cost us significantly. When our instinct is screaming for us to get out of the market, this is usually an indicator that we shouldn't. With the benefit of hindsight, it is evident that the bottom of the market is usually the period of most pessimism. Now, while we don't know when the bottom of the market will be, we do know that we are 30% closer to it. The cost of panicking is currently high for investors. To put this in perspective, I've done some research on previous market sell-offs in balance funds, which is where many of our clients are currently invested. In a typical local balance fund with approximately 70% invested in shares and the remainder in bonds and cash, the worst sell-off recorded was in 1987 too, and these funds fell 25.3% over 5 months and took the following 11 months to recover. The current crash registers as the fourth largest fall in balance funds, with a drop of 18.9% for the TRG balance fund specifically. This reveals that investors have been here before. It really isn't unusual. The crisis of the day always feels worse than the crisis of the past. Uncertainty during 9/11, the global financial crisis, was just as high as today, although it doesn't feel like it. So while there is little in your control in the current environment, remember you always have control of your actions. Our TRG fund of funds are in sound condition and have performed as we would expect them to in these difficult market conditions. We focus on risk over performance, and we can see that in looking at the JSE, which has fallen 29% from its peak in mid-February till now. Our balance fund has pulled back 18.9%, and this is compared with the average local balance fund that has lost almost 21% over the same period. Our lower equity funds have also registered much smaller drops. So what should investors be doing during a market crash? Well, firstly, in times like these, the importance of the work done with your advisor before the investment is paramount. It is for this reason that we spend time with you determining your risk tolerance, which is really can you remain invested, agreeing on your investment goals, and regularly assessing if we're on track. This helps us prepare for the inevitable and unnerving market conditions that we're currently going through, and will go through again in future. Secondly, as long as it's still appropriate, it is crucial for investors to stick to their investment strategy. As much as we may feel the urge to do something now, assuming you're in an investment of sufficient quality and is well diversified, doing nothing and sticking to your investment plan is the best course of action. And while easy to say, we understand this is very difficult to do. And thirdly, in times like this, we need to remind ourselves that is as devastating as the humanitarian and economic fallout from this virus will be, it will not last forever. The global sell-off hit the JSE at a time when our valuations were already looking quite cheap. As a result, we have been dragged lower with other markets and presenting some compelling opportunities for investors with a 5-year or longer time horizon. Now, while events remain highly uncertain in the short term, with the extent of the sell-off we've already endured, much of the risk has been priced in. Adding to investments with equity exposure or a share portfolio could be considered for clients with the appropriate risk appetite for it. While caution and risk management should always take precedence, we understand that markets are driven by sentiment in the short term and have pushed some investments into very attractive territory. So in summary, we know the current environment is unnerving. Communities across the world are grappling with common challenges on an unprecedented scale, and the volatility in financial markets is symptomatic of this. So during this period, while you are focusing on your businesses and your families, rest easy knowing we are looking after your financial assets. Stay safe and healthy. Thanks for watching.